Turn the transcripts off because I don't need them. So, okay. So, a little bit of, oh, hang on. Let me sit up before I fall down out of my chair. A little bit of housekeeping before we get started. I apologize for not being here last week. Had some issues, just timing. Had to get to the doctor's office. My wife has had a big inner ear infection and stuff, so we had to get her to the doctor's office, and we just was not going to be able to make it back in time because of the distance we had to drive. One bad thing about Texas is you get used to driving, so it doesn't seem so bad, but it can really mess with schedules when, you know, the doctor's office is an hour and a half away.
Yeah.
You know, an hour and a half drive to us most of the time is no big deal. But, you know, when the appointment's doesn't start until 4:30, nope, there was no way I was making it back last week. So anyway, all that said, I apologize for not being here. I hope you guys enjoyed your week off.
Yep.
I started to go ahead and post a video for this week's lesson that I did the last time I taught the class, but I thought, you know what? No, because the last time I taught the class, we had Thanksgiving in the middle of the class, and we missed a week anyway. So I figured I'd just give you guys a week off. I meant to go in Canvas and adjust the due dates on the homework assignments. So for everybody, I will try to get that done this evening. If not this evening, I'll try to get it done in the morning. The bottom line, though, and I just sent an email out telling everybody, is that basically if you look at the assignment and it hasn't been adjusted, then just push it back a week. Okay. So like the assignment for this week right now says it's due at midnight tonight, right? Or midnight last night.
Last night.
I'm pretty sure.
Yeah. So the bottom line is it's not due until next Monday evening. Okay. And like I said, I'll try to get those adjustments done this evening. For those of you that there's 2 people that have already done the assignment and turned it in. I have not looked at it. I just noticed that there were 2 people that have done it. If you've done the assignment and you've turned it in and you feel comfortable with it and want to leave it, that's fine. But after watching the video, and again, I'm going to send a message to those 2 people specifically when we get done here. But if you want to, after you watch the video, if you want to pull pull the work and redo it and then resubmit, I'm fine with that too. I have no problem with that. I did not get enough guidance to you guys. I think a couple people thought that they had to get it in because of the due date. Okay, so anyway, all of that said, I hope you guys did enjoy the week. Actually, been 2 weeks since we talked now, so I hope you've enjoyed the last 2 weeks. And if I'm yelling at you, please say, "Hey, Dave, we can hear you," because literally my wife has had inner ear infection, and they call it a bilateral because it's on both ears, to a point that she's busted one of her eardrums. So in order for her to hear me say anything, I have to yell at her right now. So and that tends to get to be a habit. So am I lagging on you guys? Or are we good this time?
No, we're doing good this time.
Okay. So if I do start yelling at you, just take that into consideration, that it's not you, it's me, and I will try to make sure that I don't do that. I figure if she gets to the point where she can hear me talking, she's going to come tell me I don't have to yell. But okay, so this week's lesson, we're going to take and build a little bit on what we did from 2 weeks ago, where we were doing the break-even points. And so now what we're going to do is we're going to say, okay, now we've kind of figured out how to calculate what our break-even point is, but let's figure out, or let's talk about how we want to set our books up and what style of costing mechanism or cost method do we want to use. And by that, I mean, and let me see, whoops, I need to start sharing these slides because it doesn't do any good to advance them if I'm not sharing them. Okay, you guys seeing the slides okay?
Mm-hmm.
Yep.
All right, let me get this back up.
Oh, I meant to ask, does the week we just had off replace the week that's normally between the 2 cycles?
No. This class
Oh.
will this class will still end on the normal time.
Okay.
Yeah,
Just
they don't
checking.
let me extend the classes. I
Okay.
just if you're taking a class and a professor has to have time off, we have to do one of two things. We either have to, give you some work to do, a video to watch, a book to read, depending on the class, so you've got academic activity during that week, or we have to choose to let that week slide and then combine condense our curriculum a little bit. So, and basically, since I knew I had Thanksgiving, because last semester I taught this class on Thursday, and I knew I had Thanksgiving, and obviously I wasn't going to have people trying to come to class on Thanksgiving night. So I just crunched it down into 7 weeks. So when I realized I wasn't going to be here last week, kind of shifted to that format. So anyway, so there we go. Now it's advancing. All right, you guys see in the slide it says absorption and variable costing?
Yep.
Yeah.
Okay, cool. Let me do this. Is this gonna work? Give me a second. I'm playing with my screens here. No, that's not working. Okay. Let's just do it that way. All right, so absorption and variable costing, two costing methods. Now we've talked about variable cost and fixed costs and variable cost, fixed cost, and mixed cost last time. That's cost, where we were talking about cost of an item and how we do. This is costing. Same root word, obviously, but different. We're talking about how we work our books, how we decide how we're going to charge things within our system. Okay. So learning objective 1, distinguishing the difference between the two. Okay. So variable cost versus absorption cost versus variable cost. Okay. Assigns both variable cost. Okay. So look at this. So we're talking absorption cost, absorption versus variable costing. Okay. But down here, we're taking the ing off of it. So now what we're doing is we're talking about how we're working those costs to go into our costing. Okay. So assigns both the variable cost and the fixed manufacturing cost into the product. That's key. What we're doing with the fixed cost is key in understanding the difference between the two. Okay. Now, as we go along, you guys remember back a couple of weeks ago, we used the term GAAP, which is generally accepted accounting principles. We used that back when we were talking about the difference between financial accounting and managerial accounting. It's the same process, okay? GAAP is a required method. Let me rephrase that. The absorption costing is the type costing that's used most of the time when we're dealing with outside people. Okay, it's GAAP. Man, I'm struggling with how I want to word this tonight, and I apologize. Because absorption costing is preferred by the financial folks, we follow the GAAP, okay? And the reason why it's preferred is because most of the accounting world still uses absorption costing, okay? Absorption costing has been around for as long as accounting has been around, if you will, okay? I know we can trace absorption costing, or it wasn't called that back then, but the methodology that we use for absorption costing, we can trace it back past the Revolutionary War, back into England and France and how they did accounting back there. Where the variable costing that we're going to talk about here in a little bit is something that's relatively new, something that some smart accounting whiz came up with back between World War I and World War II. So it's been around for 70 plus years, which to us seems like it's been around for a while. Got it? But the reality is when you compare it to absorption costing, it's still the new kid on the block. All right. And a lot of folks have taken a while to warm to it. I will tell you that a good bit of manufacturing companies, at least across the United States anyway, have really made the switch over in the last 20 years to using this absorption or the variable costing, just simply because it gives us more accurate numbers. So, you know, when we look at it, again, the absorption costing, we have our variable cost and our fixed cost both figured into the cost of our product. In the variable costing, we assign only the variable cost to the manufacturer. We take the fixed cost and we expense it later. Okay, and in a couple of videos that we're going to watch tonight, the guy in the video does a very good job of explaining this process and why we save it for later. I will attempt to do so prior to watching the video, but he just always seems to do a better job of it than I do. Okay, and this variable costing is also the stuff that's preferred by management accounting. And again, I go back to the reason why it's preferred for management accounting is it gives you a more accurate, realistic, true set of numbers of what's happening right now, as opposed to waiting. Because what happens is when you have your fixed costs wrapped up in your product, if you don't sell your product and it's setting off in a warehouse, you get numbers that are not accurate. And by that I mean, if I have to pay rent and utilities and all of these other fixed costs when I'm manufacturing something, in a variable costing system, we charge it off as a period cost. We charge it off when it happens. In an absorption costing mechanism or methodology, we charge it off when we sell our product. So if we make a whole bunch of stuff and we stick it off in the warehouse and we haven't sold it yet, I've got costs that I've already paid money out for because I had to pay the rent and I had to pay the lights and all of that stuff. And I'm not accounting for it as I'm spending it. And I don't account for it until it comes out of the warehouse and we actually sell it. Okay. Again, this method is the absorption method is the method. It's a tried and true method. It's been around for hundreds of years and it still works. This method is a much newer, much younger system. It's one that's preferred by most folks now in the manufacturing world. I can't say all, because I learned a long time ago that you never get 100% of the people to say that they agree on anything. Okay, but we're going to spend a fair amount of time understanding the variable costing system, because as you guys move out into the business world, all of you, but as you guys move out into the business world, this is the methodology that you are most likely to run across. Okay, and again, what I was saying earlier, the difference between the absorption and the variable cost is what do we do with the fixed manufacturing costs. Okay, if we put it in the absorption cost, it becomes part of our inventory product cost. If we do it with a variable costing method, it becomes part of our period cost. We charge it off as in the period in which the expense happened. That's literally, guys, that's it for learning objective one. Just understanding that we have two different costing systems, and the only difference between the two is what do we do with the fixed costs. Okay? So we're going to do some Actually, I think, yeah, I did. I switched things around a little bit. So we're going to watch a video. If I'm not mistaken, this one should be about 20 minutes. Let me get this up here real quick.
I already tried watching those YouTube videos in a futile attempt to do that assignment.
If you are tired of paying too much money for electricity,
okay, hang on a second.
and have a history of paying your bills on time. In this video, we're going to talk.
Now, say that again. I'm sorry.
I already watched some of these YouTube videos in a futile attempt to get that assignment done today.
Okay. Did you watch the ones that were on these slides?
Yeah, I went through the slides.
Okay, well, you get to watch it again because other people haven't seen it. So maybe it'll help. Maybe it'll help going through this time. Okay, so absorption costing. This is where we keep the fixed costs wrapped up inside what we're doing with the what we're doing with our overall cost. I'm sorry, my brain's half out of it today. So let me full screen. I'm going to stop sharing. I'm going to start sharing again. Oops, hit the wrong button. Actually, I didn't hit the wrong button. I just didn't hit another button that I was supposed to hit first. Okay, so stop sharing, start sharing.
About absorption costing, which is also known as.
Can you guys hear that?
And when we talk about full cost or absorption cost.
All right, hang on. It's messed up.
Think about it, man.
Oh, sorry, my mic was muted. I can hear that video.
You could or could
Yeah.
not?
I could, yeah, sorry.
Oh, okay.
My
I
mic
could
was
hear it,
muted.
but it sounded like it was playing on a speaker in that room and then coming through your microphone.
Yeah, see, that's what I'm trying to get it so it plays. Go to the audio device and select. I have it. This was working fine last 2 weeks ago. What's messed up now? Go to the device audio settings and select. I don't. It should not be coming up there. This is going to get real frustrating, guys. Hang on a second. What does my speakers have to do with the fact that I'm trying to put it across to you guys? I did what you told me to do, computer. It says cannot share sound. Go to device audio settings and select speakers. Realtek high definition audio. I did that. Okay, you guys stay in this Teams meeting for a minute. I'm gonna restart. I'm gonna go all the way out and come back in and see if that makes a difference. I know I had
Okay.
I know I had problems a couple of semesters ago.
If only computers would work.
Exactly. Is
I
this still
got it.
part like? Is this still getting recorded for the online people?
Yeah.
Nice.
Okay, I'm back. Is it still recording?
Yep.
Think so.
Okay. Okay. No, I hate doing it this way, but this is what we're gonna have to do. All right, this is a 20-minute video. All right, I have 625, so that would be 645. So you guys watch this video, and everybody else at home kind of do the same thing. Watch the video, and then we will come back at 6:45. Let's say 6:50. That way, after you get done watching the video, if you want to grab something to drink, you can. But at 6:50, we'll come back and we'll talk about what was on the video. Okay? My
Okay.
apologies, guys. I have no idea. So what I'm going to do is I'm going to mute my camera and mute my mic. You guys do the same. When you're done watching the video and ready, pop back in. Okay?
Okay.
Hey, hey.
Hey.
So did that make any sense at all to you?
Sure.
I think so.
At least right now while you're thinking about it. Now, the question is, will it make any sense to you in 2 or 3 days when you go to do your homework, right?
Yeah, that's the question.
Okay, so let's talk a little bit about what the guy was talking about there. Okay, so fixed, when we're doing the absorption costing method, excuse me, absorption costing method, the fixed manufacturing cost is divided out by the total number of units as we go to get our per unit cost for that time period, whether it's quarter one, quarter two. So you saw when he was doing that, he had his per unit cost. So his direct labor per unit cost, that was easy. The direct materials, that was easy. The variable overhead, that was easy. But then when we came to the fixed cost, initially we didn't have what the per unit cost was. So he had to take the fixed cost for the quarter and divide it by how many units he made during that quarter. That's why it broke it out and gave you two different numbers. Because remember, in quarter one he only made 10 balloons, where in quarter two he made 20 balloons. Okay, Jacob, you got a bit of a puzzled look on your face.
Well, the only thing I gotta say about that is like, okay, I understand that. I understand that the fixed cost got spread over the more units, and that's why the cost is different. But the variable stayed the same in the cost.
Correct.
Right. So that means they were able to produce the same amount of balloons or more balloons for like
No.
less money.
Remember, in the example he was giving you the cost per balloon. They made 20 balloons, so the variable cost went higher. The fixed cost for the fixed materials went higher. Or excuse me, the direct labor went higher, the direct materials went higher, the variable overhead went higher because they made 20 balloons. But the cost per balloon stayed the same.
Okay.
Okay?
Okay, that's what I was puzzled about. I must have missed that or something, not paid attention enough.
Okay, so in his example, yes, when you think back to what we were doing last week, if your number of production goes up, your variable cost is going to go up, and his overall variable cost did go up. But
fixed cost wouldn't change.
The fixed cost wouldn't change, and his cost per unit doesn't change.
No.
Okay.
Okay.
So remember the first three numbers he was giving you there, somebody else had already calculated, and that's what'll happen with our assignment stuff. Somebody else will.
Oh, okay, that makes a lot more sense to me now. I wasn't thinking through that. Okay.
Yeah, somebody else will have already calculated what the fixed cost, or excuse me, what the direct labor cost. Let me rephrase that. You may have to calculate it, but ultimately in this costing system, what you're trying to get to is what is our cost per unit.
Yeah.
Okay, that's the key thing. What's our cost per unit? And I was telling David before you came on, and before I started the recording, this is the week when I'm grading the homework where I get to laugh at the students the most. Okay, and I don't mean that to say that I'm laughing at you. Okay, but it's funny to me, and it happens every time that it happens this week. You guys have been drilling, and you're so focused on what's happening. Yeah, you end up overthinking it.
Yeah.
Okay, so listen to kind of like we were doing before when we were doing the story problems. Read. David, are you with us?
Yeah, I'm here.
Okay, I thought I heard you a while ago. I just wanted to make sure. So make sure you read the story problem and pay attention to what the story problem is telling you.
Yeah.
Okay. So anyway, our fixed manufacturing costs are divided by the total number of units produced to get our cost per unit.
Yes.
Okay. And then in units produced but not sold result in a higher higher finished goods in inventory. So again, going back to, remember the first quarter he made 10 balloons and sold 10 balloons.
Mm-hmm.
The second
There's nothing
quarter he
left in
made,
inventory.
yeah, the second quarter he made 20 balloons and sold 10. So he made more balloons, so those balloons went into inventory.
Yes.
Okay. Now, that's neither, without any more information in front of us, that's not necessarily, that's neither good nor bad.
No.
Okay. There are times when you want to make more inventory in a specific quarter.
Mm-hmm.
There are times when you do not want to have extra inventory going into the warehouse, and conditions will dictate that. By that I mean, what may have happened is, quarter one may have been, he may start his quarters instead of in October like a lot of companies do for fiscal stuff. He may actually start his stuff on the 1st of January. So in January, February, March, he's not making, he's making 10 balloons, he's selling 10 balloons. Well, then April, May, and June, he's selling 10 balloons a quarter, but he decided to make 20 because it may be that historically he knows that in July, August, and September, he's going to sell more balloons.
Yeah.
Okay.
So he wants to have them.
He wants to have some in inventory so that he can push those out as soon as those orders come in. Again, the scenario that he was giving us, we don't know why he made 20 extra balloons, or excuse me, 10 extra balloons. Okay. Now the flip side of that, and this is one of the things we'll get to in a little bit, but I think it's good to go ahead and mention it here. Sometimes when our bonus is based on our production, excuse me. My brain just is not working. My dyslexia is playing flippity flop in my brain tonight. When it can cause problems when we're doing it using the absorption cost, because you notice how nothing changed, but yet it looked like we were more profitable in quarter two than we were in quarter one, right?
Mm-hmm.
It was 430 in profit. I mean, our cost.
400,000. Yeah, sorry.
Yeah, our cost was 430 in quarter one, but our cost was only 400,000 in quarter two. Okay. Yeah. So when we tie, let's say we tie a manager's bonus to his production costs. Well, if he makes more, he's still spending the same amount of money. In this case, he actually spent more money because he made more. So those other costs are going to go up, but our cost per item, it just looks like we're more profitable in quarter two. We're really not. We just stuck stuff off in the warehouse. Okay, so that's something we have to keep in mind, because you get somebody in there who's kind of unscrupulous. Hey, maybe we're talking about the quarter. Maybe we're talking about the quarter that is July, August, and September. Well, I want my July, August, and September numbers to look real good because I want a nice fat bonus check before I go into Christmas holidays.
Mm-hmm.
Okay, so just one of the things that we have to keep in mind. All right, so kind of work the math that he was doing. Okay, so our manufacturing overhead cost per unit is the total fixed manufacturing overhead. In his example, it was the $60,000. Mm-hmm. That's the fixed manufacturing overhead divided by the total products produced. One quarter he produced 10, another quarter he produced 20. Okay, so that's how we're going to get our fixed overhead per unit cost.
Mm-hmm.
Okay, so
are you meaning to have slides up right now? Because if you are, I don't have them.
Okay, yeah, let me back up a half a second. Yeah, you got them now?
I do, yeah.
Okay, so where we were talking, this is the fixed manufacturing. You saw me looking over there. You thought I was looking at
Well, I was wondering about it because I figured we were explaining it a little bit after the video and then go back into the slides.
Yeah.
And when I saw you looking over, I wondered.
So our fixed manufacturing cost is divided by our total units produced to get our cost for that, our cost per unit for that period. Okay. Units produced but not sold will result in a higher finished goods inventory. It's an asset because we've got it sitting there and we're putting it over in the warehouse.
Yeah.
Okay. So breaking it down, the fixed manufacturing overhead cost per unit or per unit for the period is the total, the 60,000 in his example, divided by the total number of units produced. Quarter one, he produced 10. Quarter two, he produced
20.
20. Okay, so that was the reason why he had, in quarter one, his cost per unit was $6,000, but in quarter two, his cost per unit was $3,000. Okay, pretty simple calculation there. All right, so let's look at that. Okay, so $2. So if this is a different example, this is an example from the book. If you open the book 6.4, so if our fixed manufacturing overhead is 200,000, and we sold 100,000 of whatever it was, you just do the simple math. 200,000 divided by 100,000 is going to give us $2 per unit. You tracking with me, David? Pretty straightforward, right?
Yep.
Okay. So now we're going to switch and look at the other method. If you guys track with this one, okay, just remember the difference between the two is what are we doing with the fixed cost? In absorption cost, we have to add the fixed cost in. In variable cost, we do not add the fixed cost in. So in absorption cost, we have to take our total overhead divided by however many we did to get our cost per unit. I think, if I'm not mistaken, 6.4, they're talking about brushes. $200,000 in fixed overhead. They made 100,000 brushes, so their fixed overhead cost per unit is $2 per brush. This is me trying to remember, okay? So now we're going to kind of do the same thing, only we're going to look at variable costs and how it's different. And he uses the same hot air balloon company, but he's going to show you the difference in how it works out, okay? So we're going to do the same thing here. I'm going to try it and see if it'll let me. Your browser. I know my browser's up to date. Technology, it works great when it works. Okay, let me get to the right slide again.
So I've got my essay written.
So are you guys seeing that?
For about a week.
Yep.
I'm going to pause it when I can get past this commercial.
And I'm going to.
Okay. So I stopped sharing. I'm going to start sharing again. Okay. The audio is still not going to work. So we're going to do the same thing on this one that we did on the last one. Okay. We're going to watch the video. This video is 11 minutes long. I've got 7:05 right now, so that's going to get us to about 7:20. So let's watch this video, and then we'll actually take a break until 7:30. Okay? So I'll see you guys back at 7:30 after you watch this video.
Okay. Sounds good.
Hey, gotta call you back. I'm teaching a class. Okay.
I'm present.
She's gonna fuss at me like I do her. I always tell her, look, if you're busy, just don't answer the phone. So, did that one make any sense to you?
Yeah.
Okay. Can you see the difference in why it makes why we as managers, why we as internal folks inside the company, the variable costing method is going to be the one that we're going to prefer?
Yep.
It's going to allow us to see our expenses as they happen. Okay, so let me start sharing these slides again. You guys seeing a spreadsheet?
Yep.
Yep.
Now, how's it that part works for me, but the audio is not working right tonight? So grab your books and open it up to page 287.
Got it.
Giving Jacob a chance to catch up with us.
I got it.
Okay, so we're going to do exercise 6-17 from the book, absorption costing. And if you look down there, the first requirement says prepare both conventional absorption costing and the contribution margin or variable costing method income statement for the swim clearly. Okay, so we're going to do both of them here. All right, so let's read what the story has to tell us. In 2010, data for the following pertain to Swim Clearly, the manufacturing of swimming goggles. Swim Clearly had no beginning inventory in January of 2010. So they started off with no inventory. Whether they're a new company or whether they sold everything they had before the holidays, we don't know. Okay, but let's look at the little chart that they give us there. We know the sales price is $41 per goggle. We know that the manufacturing expense per unit, the variable manufacturing expense per unit is $22 per unit. We know that the sales commission is $6 per unit. We know that the fixed manufacturing overhead is $2 million. We know that the fixed operating expense is $250,000. The number of goggles produced is 200,000, and the number of goggles sold is 185,000. So in that little bitty box right there, it gives us everything we need in order to do our our absorption costing and our variable costing. So we're going to put it on a spreadsheet. All right. So I've got the sales revenue in there. The 7,585,000 in sales revenue. Now, how did I get that number?
You multiplied number of goggles sold by sale price.
Okay, and in that chart it tells us it's what? Because you can't see my math here, so
Yeah, it's 185,000 times 41.
there you go. Let's see if I can make this work right. So $41 per times the 185,000. Okay. So now we got to figure out what our cost of goods sold was, right?
Yeah.
So our beginning inventory, the story tells us we assume that they had no beginning inventory, so that's real easy, right? Cost of goods manufactured. How did I get the cost of goods manufactured for that slide?
$185,000 times the cost to manufacture a unit.
Cost of goods manufactured would just be you would just add up all of the cost you have to actually manufacture, right?
Say that again, I'm sorry.
The cost of good manufactured would just be the cost that you have to actually manufacture. So it would be oh no, I'm wrong.
I'm seeing expense per unit on the 6-17 in my book.
Oh yeah, he's right. It would be that $22 per that 185,000. No, the 200,000 because they made 200,000 units.
But it's yeah, correct. Okay, so we're in the.
Well, maybe I wasn't entirely right. Because you have to add the fixed cost. The 22 is just the variable cost.
Yeah, because remember we're doing absorption costing in this one. So we know that the variable.
Okay.
So we know that the variable cost per unit is $22 per unit, but we know that our fixed manufacturing overhead is $2 million, right?
Yep.
Mm-hmm.
Okay, and we know that we produce 200,000. So again, we're trying to figure out what it costs us per unit. So our fixed.
Oh yeah. So then it would be variable cost. Wait, variable manufacturing expense per unit times number of units produced plus the overhead.
Correct.
So that would get us 22 times 200,000 plus 2 million.
Correct. Cost of goods manufactured. Okay. So the $22 plus the $10, because what hang on. So what I did was I broke it down a step further. Okay. So up here, because we know it's $22 per unit on the variable cost. So we need to figure out what our cost per unit is from our fixed. So we take the $2 million divided by the 200,000 gives us $10 per fixed. Okay. Now what you did was accurate. Okay. You took the 22 times the 200,000 plus the 2 million. Mm-hmm. Here I just figured out what it is. So then when we come down here,
so then you can multiply that 32 by the 200,000 and get 6.4 million.
Right.
Okay.
You tracking, David? You tracking?
Yep, I'm following.
Okay, so you can use either method. Okay. What I was trying to do is, so we know that it's $32 per goggle is our cost.
Mm-hmm.
In the absorption method, because we're figuring our fixed cost into it, it's $32 times the 200,000 that we made gives us the 6,400,000. Okay. Now our cost. So if this is what if this was how much we sold, or excuse me, if this was our cost of good manufacturing, our cost of goods available for sale. The only difference, the reason this is the same number is because we had nothing in inventory. If there had been something in inventory, we would have added the inventory to what we manufactured to give us what's available to sell. Does that make sense?
Yes.
Okay. What did we make plus what we had is what we've got available to sell.
Okay.
Okay. In this case, it's 0 because we had no beginning inventory.
Exactly.
Okay. So here, that's how we're at our 6,400,000 right here. Okay. Mm-hmm. Now, so we know it's $32 per goggle, and that's the reason that I broke it out this way, so we know how much it is per goggle. Our cost is $32 per goggle. So if we know it's $32 per goggle, and the book tells us that we only sold 185,000, that means we got 15,000 we didn't sell, right? So we've got 15,000 going into our finished goods inventory. Mm-hmm. Okay. So then we just simply do the math and we subtract the 15,000 from the 6 million, or excuse me, the 480,000 from the 6,400,000. That gives us the 5,920. Mm-hmm. Does that make sense to you? So this is what's available. This is what we didn't sell. So if we take what's available minus what we didn't sell, that has to be what we did sell, right?
Yep.
Okay, so if this is what our cost of goods sold is, this is how much money we have in revenues. If we do the subtraction there, we had 7,585,000 in sales. It cost us 5,920,000 to make it. So our gross profit is 1,665,000. You guys tracking with me there?
Yep.
So we did this over here, and that's why you want to have multiple columns in a spreadsheet. So we did our cost of goods sold. Okay, we know what our available was. We know what we had remaining. We do that math and we put it over here. Now we take our revenues minus what it cost us, and this is our gross profit. Okay, but then we also have to account for the sales commission per unit. Now, gross profit. Okay, this is our cost of goods sold, gross profit. Gross profit goes to pay for everything else. SG&A. In this case, they're not accounting for SG&A, but they are accounting for their operating expense in that we have a sales commission. We have to pay the salesman for every pair of goggles. Okay? So if we take the $6 per goggle times 185,000 and we sold $250,000, okay? Oh, plus the 250. Hang on. Oh, because it says fixed operating expenses. They're calling it fixed operating expenses here. Okay. In the video, the guy called it SG&A. It's a 1/2 dozen of the other. So we have to take our sales commission and add it to our fixed operating, and that gives us our 1,360,000, which is our operating income, which then gives us our operating income. Are you guys tracking with this?
Yep.
Yeah.
Yeah. Let me show you. If you guys pull these slides up and you've got it in slide presentation the way I have it here, and you get to this slide, as you click, one click at a time, it brings those little boxes up. Okay? So you can kind of track along with how I did it if you need this as a reference for when you're doing your homework. Okay? So on a variable, we've got the same revenue that we had before, right? Because nothing changed. We still sold 185,000 of them. We still sold them for $41,000 or $41 a piece. So we still got the same $7,585,000 in sales. Okay?
Yeah.
We still have this. Now we're going for our variable cost of goods sold. Okay, and we're labeling it differently. We're saying variable cost of goods sold because the other one was the absorption, and we just said cost of goods sold over there. Okay, so I broke it out and specified here that it's variable cost of goods sold. We still got the same inventory, or zero beginning inventory, right? Okay, and it says that our variable manufacturing expense is $22 per, right? Okay, and we made 200,000. So that's where I got the 4,400,000 from. Took the information the book gave us. Somebody else has already calculated what the variable expense was. That's the nice thing about this point in the class. Somebody else has done some of the grunt work for us. So we know our variable expense is $22. We know we made 200,000 of them. Okay, so our variable cost is 400,000. Okay, again, variable cost of goods available. If this is our cost of goods manufactured, we didn't have anything to begin with. That's what we have available. Okay. Now, remember before we had the 22 plus the 10, so we had the 32 times the 1,500 goggles we didn't sell. Well, now we're not carrying that fixed cost into this portion of it. So now we're just taking the same 22,000 or $22 that we used here times the 15,000 to give us $330,000 in ending inventory. Okay. Again, just do the simple math, and you get the $4,070,000. Okay. Now that's our variable cost of goods sold, $4,070,000. But now we still have to take into account these other expenses. Okay. Oh, excuse me. So I'm going to, before I get to my contribution margin, because remember we defined contribution margin a couple of weeks ago as those monies that are left to pay our fixed expenses. Okay.
Mhm.
Well, in this case, we have a sales commission. So I'm going to put the sales commission after my variable goods sold, but before my contribution margin, because however many I sell comes into play here on for this guy. Oops. Didn't put any more bubbles in on that one. So if I take my sales, man, I can't talk tonight. If I take my $6 and I know we sold 185,000, that gives us our 1,110,000. So we we add these together because this is an expense, a variable cost of goods sold. We add our sales expense to that, which gives us our 5,180,000. Now we do our math. This is our revenues minus our expenses, gives us our 2,405,000. Okay. So get our contribution margin. This is what it cost us to make and sell those 185,000 goggles. Now, mind you, we made 200,000, but we subtracted the value of the 15,000 that we didn't make out of there. So our revenues minus our expenses, okay, gives us our 2,405,000. This is where, and this is the part about trying to teach this long distance I hate, because right now, if I was with you guys, I'd be scribbling all over the board. Kind of hard for me to do that here, okay? So anyway, we've got our 2,405,000. Now the book told us that our fixed manufacturing overhead was $2 million, right? It also told us that our fixed operating expense was 250,000. So to get our fixed expenses, we're going to add these two together, 2,250,000. We know we had 2,405,000 up here. So we just simply do the math again, subtracting the 2,250,000 from the 405,000 to get 155,000.
It's a
Okay.
far cry from the other one.
Say again?
It's a far cry from the other
Yeah,
one.
we're gonna do the next slide. Okay. So our cost of goods sold, 6,400,000 versus our variable cost of goods sold, 4,400,000. There's a $2 million difference. Well, what was that $2 million?
The fixed costs.
The fixed manufacturing overhead. Okay. Make sure you you got to make sure you differentiate between the two. You got fixed expenses and you got fixed manufacturing overhead.
You got to put it in the right place.
Yeah. So when we're talking cost of goods sold, it's the fixed manufacturing overhead that that we're playing with. Okay. So our finished goods inventory, 480,000 versus 480,000 versus 330,000. It's 150,000 difference. Where's that 150,000 coming from?
The fixed manufacturing overhead difference being calculated into the cost of the product.
Right, because you remember if we took the 2 million divided by the 200,000 goggles, per goggle it was 10. Well, if you take $10 per goggle times the 15,000 goggles that we didn't sell, there's the 150,000. Making sense?
Yep.
Now, you guys are not going to have to do this. This is just something I did up to kind of show you the analysis here, okay? The fixed manufacturing cost shows separate, okay? So fixed manufacturing cost, okay, in the absorption, we've already got it added in up here, right? Well, down here, we have to add it separate line to add it in for the variable side. Okay?
Yep.
That making sense? Does it honestly make a little bit of sense?
Yeah, it does. I'm not sure I entirely have the whole train connected, but
Yeah. But it'll get
as long
better
as I
when we
got all
actually do
the
the problem.
Yeah. As you do it, it'll make more sense. Okay.
as long as I got the train car with the coal, I'll get there. I mean, if I miss a couple passenger cars, we'll be all right.
Do I want to continue? Yes, I want to continue.
The worst thing I've ever done for my computer in relation to those warnings was join a Proctor U session.
Working on it for about a week.
Yeah.
So now I'm going to show you how I use
I had
grammar.
to factory reset it. That
Here's
Proctor
Lance.
got in there and ruined my thing.
We're going to talk about the difference.
Okay. So we got one more video. This one's only about 9 minutes long. So as soon as you're done watching this video, pop right back up. Okay.
Okay.
All right. I'm back.
All right, Dave. All right, so did that last video help any kind of putting the two of them side by side?
Yep.
To make a little more sense now, David, than it did when you were trying to do it on your own earlier?
A lot more sense.
Well, I'm glad I'm at least helping explain it a little bit. Okay, so let me get, are you guys seeing the slides?
Yep.
Okay,
Mhm.
wasn't sure if it was still showing or not. We got just a few more slides to get through, and we'll be done for the evening. Okay. So, absorption costing. Kind of the stuff he was hitting at right at the very end of that video. Okay, absorption costing pros and cons. The pros is that it's generally accepted accounting principles. Okay, and it is that way because that's the way everybody's done it forever. And accountants, for the most part, do not like change. Numbers are numbers and they don't change. At least that's what they think. So they don't like to change methodologies. And the reality is kind of like we were talking about way back in week one, financial reporting and generally accepted, the gap, is something that everybody does. That way we can compare apples to apples and oranges to oranges. Okay. It also clearly ties all the production costs to the product. That's the pros. Con, that the fixed overhead is kind of hidden. If you have, now if you're selling the same amount that you're making and you're moving along and it's consistent, and you may fluctuate a little bit from month to month, but it's consistent, then that may not necessarily be a con. When it becomes a con is when your inventory starts to creep up because you're hiding expenses in your inventory then. But if you start off with, if you start off with $100,000 worth of inventory, and you end the period, whether it's a month or a quarter, if you end the period with $98,000 in inventory, or you end the period in $102,000 in inventory, not a big deal. But if you start off the period with $100,000 in finished goods inventory, but at the end of that period you end up with $150,000 in finished goods inventory, well, now your finished goods inventory has just gone up by 50%. And then that's when it begins to become a problem. And like we said, you could have, if you've got an unscrupulous manager out there that wants to make his profitability look better because his bonus check is based on his profitability, and he gets a chance to do that. There's folks that will do it in order to get a bigger bonus check when it comes to maybe the quarter before the holidays. So we'll flip it around. Obviously, basically what we're going to do is we're just going to flip it around, and those same things that were pros and cons are flipped over. Okay. In the variable costing, one of the things that we've been talking about all the way through this is that, if we're going to try to go to a just-in-time inventory type process, we need to know what our costs are during the period in which those costs exist, so that we can manage our timelines better. Okay. By working it out and having a contribution margin or the variable costing method, it makes it much easier for us to be able to do our cost volume profit analysis, to be able to determine, are we making the profit that we want to make, because we're able to measure our income or our expenses in the periods in which they happen, so that we know what our flow is. Okay. Our fixed costs can be itemized, but one that's a big one for me is our expenses are more closely matched to our cash flow. Okay, going back to the example we had where he was doing the balloons, I would much rather charge, if I've got rent and utilities and all of these fixed incomes, I would much rather charge them off and pay them out when they're happening, as to have a whole bunch of stuff go off in the inventory that may sit there for 2, 3, 4, 5 months, and I don't charge them off. My cash flows, my money's already gone out the door. but I don't have the income coming back in the door because I haven't sold it yet, sitting in inventory. So that's a big one for me. Being working down in the oil rigs or down in the gas and oil industry, cash flow is a big thing down there because the bosses and the owners got a whole bunch of money invested. So we need to be able to follow that cash flow to make sure that our expenses are pretty much matching with our cash flow. Cons, fixed costs are itemized, which it can kind of be bad in a seasonal. If your fixed costs are the same in October, November, December as they are in January, February, and March, but your sales are dropped by 1/3 or 1/2 in January, February, and March, it can sting a little bit because you're still charging it off as it happens, but you're not bringing in nearly as much in revenues. So, and again, it's not GAAP, so the accountants, especially those people that deal with external accounting, they don't like it. Let me look and see what this video was. I didn't remember having another video on here.
Homeowners, if you are tired of paying too much money for electricity,
Shut up,
have
Ab.
a history of paying your bills on time, then you could be eligible. In this video, we're going to.
Oh, that's the same video we just watched. I didn't think I had another video in here. I hate the stupid YouTube commercials, man. I have to watch the commercials on TV. I shouldn't have to watch them on my computer too.
Since they came out with YouTube TV Premium, there's a lot more ads on the non-premium version.
Okay, so that gets us to the end of our slides. So, as we have been doing in the past, let's pull the homework assignment up for two reasons. One, because that's what we've been doing, and I want to make sure you guys are tracking with the homework assignment. But two, I want to make sure I fixed my typo. Okay, so week 5, chapter 6. Let's download that. I remember seeing a typo in it, and I think I fixed it, but I don't remember for sure. Okay, so in 6-4, you're going to have to read the book, okay? And I know there's one student that doesn't have the book, so he and I will have to talk, so I'll have to give him some information. But
You're not sharing your screen. We can't see.
Oh, hang on. I thought I hit the share button. I did. I just didn't hit the other button. I hit the share. I just didn't tell it which screen to share. Okay. So for 6-4, you got to actually read the book because I didn't type the problem out on this one. Okay. It gives you some specific numbers that you got to calculate what the fixed cost per unit is. So it's going to give you a total fixed cost. How are you going to get the fixed cost per unit?
Add the fixed costs and divide by the number of units.
There you go. That gives you your cost per unit, right? Okay. And then you're going to have to get the variable cost for each toy and the absorption cost for each toy. Okay. So let's think about what's happened so far in our lesson today. What's the difference between the variable cost and the absorption cost?
The variable cost doesn't include the fixed costs.
Okay. So up here you have to figure out the fixed cost per toy, right?
Yep.
Here you have to figure out the variable cost per toy, right?
Yep.
What's the easy way to get the absorption cost per toy then?
Add the two.
There you go. See, I'm even helping you. I'm telling you how to not overthink it this time. Okay. Now, I put this in here because we really haven't dealt with admin expenses and stuff as much. So I went ahead and plugged a couple of the numbers in here. If you notice, I even did some of the math for you out here. You guys just gotta plug the information in as it applies. Okay. So this 100,000, there is no variable selling expense. So this 100,000 just transfers down here to become this. Okay. In this case over here, though, we've got a fixed selling expense, fixed manufacturing expense. So you're going to have to put the fixed manufacturing expense and add the two together and bring them over here. Okay?
Yep.
Where that dash is, I'm already telling you, there's nothing that goes there. Okay? And then down here, this you're gonna in your words explain to me, okay? Let's see, read the problem. So basically, you down here, you're going to explain to me how to work or read the book. It'll tell you. I don't remember. Basically, you're going to this is not working out a spreadsheet or anything. You're in your words. You're going to explain to me and answer the question that they asked for requirement 1 or requirement 2. Okay.
I think your typo's right there. 6-8.
Identify the pros and cons on variable and absorption costing.
It says identify the pros and cons. You got that one.
Yeah, there we go. Well, I can't change it here because it's the way it's loaded into Canvas, but it's the pros and cons. So, requirement 1 is, what are the pros and cons of variable? And I think 2 is what are the pros and cons of variable costing? Okay. So pretty short homework this week. All right, and the reason I did that is because we are coming back off of that break, and that way, if you guys are behind any on some of the other stuff, you got time to get caught up. Okay. And I just drew a blank on his name. Hang on a second. I can do this. I can stop sharing. I can close that. So, Yan Ming, I drew a blank on his name. Yan Ming, I sent you an email. If you're watching the video before you see your email, I sent you an email. We can get together either Wednesday evening or Thursday evening, and I can help you with the part where you don't have your book yet. And I can help you out with that as far as giving you what you need in order to be able to answer the questions. So just send me an email back and let me know which day works best for you and what time. Okay? Do you guys have any questions?
Just that. So we got a quiz scheduled coming up for this Monday. Is the due date on that? That's good.
Yeah, it'll be the following. Yeah, I'm going to push it all back by a week.
I just want to make sure. Yeah.
Yeah. We're going to push it all back by a week. Okay?
Cool.
That'll work. All right, guys. You guys have a good night. And everybody else, have a good night as well. And I'll look for your homework. Remember, those of you that have already done this assignment, now that if you watch the video, if you want to go back and change the assignment, feel free. It'll probably be Saturday or Sunday before I even start looking at the homework for this week, because I still got a couple of them from the quiz and from the last assignment to get graded and back to you guys. All right? Y'all have a good week.
Night.
I hope you have something to eat. You didn't even shoot a rabbit tonight.